Welcome back to BitcoinDorks. In today's episode, we're delving into the latest developments from FTX as they roll out a new reorganization plan aimed at repaying customers and creditors. This marks a pivotal phase in the ongoing saga following one of the most significant collapses in the crypto space. FTX has been working through its bankruptcy process, and the new proposal is set to address the repayment of billions of dollars to those affected by the company's downfall. The plan, however, leaves several pressing questions unanswered, such as the future of FTX's crypto exchange and how they will value certain digital assets. As part of their restructuring efforts, FTX has been liquidating assets. With over $700 million in trust assets approved for liquidation by the court last month. This is part of their strategy to boost liquidity and manage substantial debts. The next steps involve submitting the plan to creditors for a crucial vote next year, which will be essential for moving forward. The backdrop to all this is the legacy of Sam Bankman-Fried, FTX's founder, whose actions led to massive financial discrepancies and ultimately the platform's downfall. Since his departure, restructuring professionals have taken over, working diligently to track down assets and untangle the complex web of debts. FTX's strategy to address its financial struggles encompasses not only internal restructuring but also significant strategic asset sales. This multifaceted approach highlights the drastic but necessary measures the company is undertaking to settle its substantial debts and provide restitution to its creditors and customers. One of the notable steps in this financial reshuffling involves the sale of Digital Custody Incorporated, a subsidiary of FTX, to the crypto exchange CoinList for a sum of $500,000, a transaction amount that starkly contrasts with the asset's initial purchase price, underscoring the severity of FTX's current financial predicament. To appreciate the full context of this move, it's essential to understand the role and valuation of Digital Custody Incorporated within the broader FTX portfolio. Initially acquired as a strategic asset to enhance FTX's offerings in secure digital asset storage, Digital Custody Incorporated was intended to bolster the company's competitive edge in the burgeoning cryptocurrency exchange market. The decision to offload this asset at a fraction of its purchase price is indicative of FTX's urgent need for liquidity and the dire financial straits in which the company finds itself. This drastic markdown in sale price highlights not only the intense pressure to liquidate assets quickly but also the challenges in finding buyers willing to invest in a market still reeling from recent upheavals. The implications of such asset sales extend beyond mere financial transactions. They signal to the market and to potential investors the depth of the crisis within FTX, and possibly set a precedent for how other distressed companies in the crypto space might handle similar liquidity crises. By divesting assets at such reduced prices, FTX is effectively acknowledging the tough market conditions and the limited room for maneuvering they face. This could potentially lead to a re-evaluation of asset worth across the sector, influencing how other firms assess their holdings and strategies during downturns. These asset sales are not isolated events but part of a broader strategy to streamline the company's operations and focus on core functions that could be salvaged and possibly made profitable again. This strategic contraction is likely accompanied by stringent cost-cutting measures and a re-evaluation of future business models and revenue streams. For FTX, refocusing on core competencies and divesting non-core assets could pave the way for a more sustainable business model, albeit on a much smaller scale than before. The sale might be perceived by existing customers as a regression in the company's capabilities to securely manage and safeguard its digital assets. This perception could severely undermine their trust, a cornerstone in the cryptocurrency exchange sector, where the assurance of asset security is paramount. The erosion of customer trust can have long-lasting repercussions, potentially leading to a decline in user base and transaction volume, which are critical for the viability of any exchange platform. This action raises serious concerns about the future direction of FTX in areas like technological innovation and customer service. These are integral components that drive competitiveness in the rapidly advancing crypto market. By divesting a key operational asset, FTX might be signaling a reduction in its commitment to advancing these areas, possibly curtailing its ability to introduce new features or improve service efficiencies that could keep it ahead of other market players. In addition, the divestiture could restrict FTX's ability to attract new talent, particularly in specialized fields such as blockchain technology and cybersecurity, which are crucial for developing new products and enhancing platform security. Potential hires might view the sale as a sign of instability or a pivot away from a growth-focused business model, making them hesitant to join the organization. Lastly, such strategic asset sales might complicate future partnerships or collaborations. Partners and collaborators typically look for stability and innovation as signs of a healthy company to engage with. This sale could be a red flag to potential partners, indicating possible financial instability or a shift away from core competencies, which could deter them from entering into strategic alliances or investing in joint ventures. In conclusion, FTX's decision to sell Digital Custody Incorporated at a substantial loss as part of its broader debt settlement strategy is a testament to the severe challenges the company faces. This move, while providing necessary liquidity, also serves as a critical indicator of the depth of FTX's financial issues and the potential long-term impact on its business and the broader crypto market. The outcome of this strategy will likely influence not only FTX's trajectory but also the strategies of other players in the cryptocurrency landscape, shaping industry standards for financial stability and strategic asset management in times of crisis. That's all for today's video. Until next time.